Okay, so today we're going to discuss our True Potential Wealth Strategy and Strategy Fund range. But before I do that, I'd just like to let you know that we've launched our True Potential UBS fund range. I'm actually going to comment on that a little bit later on. Okay, so let's turn now to the outlook and also a little bit of commentary from our fund managers. I'm going to start off with SEI. So SEI have enjoyed a really good, strong month for returns. The holding in global managed volatility has served them very well this year, and that's held within the defensive fund and also within the cautious fund. The lower volatility equity strategy, it helps to protect on the downside. Looking at the factors that SEI employ, they've been very much concentrating on value. That's been the area that they've been looking at. And actually, that's where they believe they'll deliver the best long-term returns. If we look at manager changes, you can see that SEI haven't made any changes this month. They're happy with their current positioning. Okay, so let's move on to Close Brothers. So starting off by looking at the sectors, Close Brothers have been increasing their weighting to healthcare, but they're also very cognizant around what's happening within the US elections. They're nervous that if Hillary Clinton gets into office, she starts looking at healthcare reform, then that could cause problems for this sector. So they've actually been looking at the medical device area. I think as well as that, they've been quite positive on emerging markets. They've increased their weightings to this area, and they believe that valuations in the developed markets aren't looking as attractive as within the emerging areas. Okay, so let's move on to Threadneedle. So Threadneedle have been shifting their portfolios more towards a defensive positioning, and they see greater opportunities in domestic companies and the kind of names such as Marks and Spencer's, Royal Sun Alliance and Pearson. They still don't hold any mining stocks. They don't see value in that area. They're very cautious on China, and they see base metals and commodity prices potentially being a little bit negative. Healthcare is their preferred sector, and they've got key holdings in Glaxo and AstraZeneca, and they continue to perform well for them. Okay, next let's move on to UBS. So they see opportunities within emerging markets as well. That's very much a key theme that we're seeing from our fund managers, and that's in both bonds and in equities. And they're also positive on Europe as well, where they view that there's a recovery that could potentially happen, and it's based on domestic demand rather than being export-led. They're seeing increased correlation between asset classes, with markets relaxing post-Brexit following the sharp dip in the immediate aftermath of the vote and a swift recovery following stability measures introduced by the Bank of England. So next, we've got Schroeders. So Schroeders are very cautious at the moment, and those of you that have been looking at their asset allocation will have seen that they're very heavy in cash at the moment, but that's at the expense of the bond market. They feel that current rallies in bonds and in equity markets are unsustainable. They're built on low interest rates and liquidity flows and not underpinned by company earnings, which they point out have fallen for the last 6 quarters in the US. They even feel a modest hike in interest rates is likely to make bonds fall by anything from 10% to 15% and would have an obvious knock-on effect to equities. Okay, so let's next move on to 7IM. 7IM have been performing well. What they found is their tactical asset allocation has been a key driver for their returns. They're very much positive on emerging markets and Asia going forward. They don't expect China's economy to be disruptive, and trading within Asia has been healthy, which markets are currently discounting. 7IM are very much underweight the UK, and they feel that there's a lot of economic risk there, a lot of political risk as well, and they're a bit nervous around earnings within the UK. In general, 7IM are de-risking their portfolios and are looking at alternative ways for diversification. Okay, so let's move on to Goldman Sachs. I'm going to start off with the Goldman Sachs Dynamic Fund. So Goldman Sachs have been making quite a few changes to the Dynamic Fund. So they've been reducing US equities from what was quite a large overweight position to a maximum underweight. Japanese equities have also been reduced slightly, and gilts and cash have become a sizable position within the portfolios. And this reflects Goldman's quite cautious outlook on markets. Next, if we look at Income Builder, they find that Europe and US equities are their preferred choice within the portfolio. So these are very much sort of traditional areas for income investment. The team at Goldman's look bottom up at company fundamentals, more so than looking top down and taking a complete view on the country itself. Okay, so lastly, I'm going to talk a little bit about Allianz. So Allianz remain very cautious on markets at the moment. They're forecasting a meaningful increase in volatility generally and are currently negative on all asset classes except for cash. Leverage has been reduced and the fund is now largely ungeared. Use of this facility is likely to remain muted in advance of the expected rate hike in the US later this year. Okay, that's everything from me. Thank you very much for listening today.